Good morning, and welcome to our release of first quarter 2023 performance results for FDIC-insured institutions. Despite the recent period of stress, the banking industry has proven to be quite resilient. Net income still remains high by historical measures, even after deducting one-time transactions. Asset quality metrics are favorable, and the industry remains well capitalized. However, these results, especially for earnings, include the effects of only a few weeks of the industry stress that began in early March, rather than over the course of the entire first quarter. The more lasting effects of the industry's response to that stress may not become fully apparent until we receive the second quarter results. In the first quarter, the banking industry's net income was $79.8 billion. That's an increase of $11.5 billion from the fourth quarter of 2022. After excluding accounting gains on failed bank acquisitions, net income was roughly flat from the prior quarter, but still relatively high by historical measures and would have been 13.8% higher than the year-ago quarter. For community banks, first quarter net income declined as reductions in net interest income and non-interest income were higher than decreases in provision expense and non-interest expense. Nevertheless, community bank net income improved relative to a year ago and remained high compared to the pre-pandemic average. The recent banking stress amplified the outflow of deposits from the banking system, causing total deposits to decline for the fourth consecutive quarter and at a faster rate than in prior quarters. However, deposit outflows have moderated since the end of the first quarter. The interest rates banks earned on their loans increased, but the interest rates they paid on deposits increased by a larger amount, which contributed to lower quarterly net interest margins for the industry as a whole and for community banks. The Deposit Insurance Fund balance was $116.1 billion on March 31. That's down $12.1 billion from the end of the fourth quarter. The reserve ratio, that's the fund balance relative to insured deposits, decreased by 14 basis points to 1.11% due to loss provisions for actual and anticipated failures that reduced the fund balance, as well as strong growth in insured deposits. Despite the decline, the reserve ratio currently remains on track to reach the 1.35% minimum reserve ratio by the statutory deadline of September 2028. Unrealized losses on available for sale and held to security maturities also remain elevated at $515.5 billion and may hinder future earnings, although recent declines in medium and long-term rates have reduced the volume of those unrealized losses down from $617.8 billion in the previous quarter. The banking industry continues to face significant downside risks from the effects of inflation, rising market interest rates, slower economic growth, and geopolitical uncertainty. Credit quality and profitability may weaken due to these risks and may result in a further tightening of loan underwriting, slower loan growth, higher provision expenses, and liquidity constraints. Commercial real estate portfolios, particularly loans backed by office properties, face challenges should demand for office space remain weak and property values continue to soften. These will be matters of ongoing supervisory attention by the FDIC. Now let me turn to the details of our report. As shown in this first chart, the banking industry reported net income of $79.8 billion in the first quarter. As I mentioned, that's up $11.5 billion from the prior quarter. Strong growth in non-interest income, reflecting the accounting treatment of the acquisition of two failed institutions, and record high trading revenue at large banks outpaced the lower net interest income and higher non-interest expense. As I mentioned earlier, industry net income would have been roughly flat quarter over quarter without the accounting impact of the two failed bank acquisitions. Community banks reported a decline of 4.2% in net income from last quarter, as reductions in net interest income and non-interest income were higher than decreases in provision expense and non-interest expense. Now our next chart shows that quarterly net operating revenue increased 7.6% from the fourth quarter of 2022 to $261.7 billion. After 3 consecutive quarters of increase, net interest income as a percentage of average assets declined relative to the fourth quarter, but still exceeds the pre-pandemic average. Non-interest income increased by $23 billion, or 36.5%, from fourth quarter of 2022. The accounting treatment of banks' acquisition of two failed banks represented $11.8 billion of the increase, and record high trading revenue accounted for another $7.9 billion. Our next chart shows that the net interest margin for the industry and the 5 asset size groups on which the quarterly banking profile reports. The net interest margin for the banking industry as a whole declined 7 basis points from last quarter to 3.31%, but still remains above the pre-pandemic average of 3.25%. All QBP asset size groups, except for the group with less than $100 million in assets, reported quarterly declines in the net interest margin, though the margin for the largest banks narrowed just slightly. The decline in the net interest margin for the banking industry reflects funding costs rising at a faster rate than earned asset yields over the quarter. The net interest margin for community banks also declined, and by a greater amount than for the industry as a whole. The net interest margin at community banks fell 22 basis points from the fourth quarter to 3.49%. Community banks continue to report higher net interest margins than the overall industry. Our next chart shows the quarter-over-quarter changes in the industry's yield on loans and costs of deposits, which help explain the recent tightening of the net interest margin. Both loan yields, that's the interest banks charge on loans, and deposit costs, the interest banks pay on deposits, began to increase in the second quarter of 2022 when market interest rates began to increase rapidly. Loan yields increased significantly more than deposit costs between the second quarter of 2022 and the fourth quarter. However, that trend reversed in the first quarter of this year as the banking industry reported that yields on loans increased by 32 basis points, while the cost of deposits increased by 43 basis points. Over the course of the quarter, the industry reported a sizable shift from lower yielding accounts such as transaction and savings accounts into higher yielding time deposits, which explains much of the increase in deposit costs. Historical experience suggests that the gap between changes in loan yields and deposit costs tends to increase in rate rising cycles, but then decreases and often reverses when market rates stabilize or decline. Now, our next chart shows that the banking industry's holdings of longer-term loans and securities declined to 38.5% of total assets in the first quarter, driven by a reduction in securities portfolios. Loans and securities with longer maturities and locked-in lower yields may hinder earnings in coming quarters. Compared with the industry, community banks continue to report a higher proportion of assets with maturities longer than 3 years at 53.9% of total assets. This next chart shows the elevated level of unrealized losses on investment securities due to the increases in market interest rates since the beginning of 2022. Unrealized losses on available for sale and held to maturities totaled $515.5 billion in the first quarter. That's actually down 16.5% from the prior quarter, primarily due to declines in medium and long-term interest rates. The FDIC is closely monitoring liquidity and access to funding across the banking industry. This next chart shows liquid assets as a ratio of total deposits, which is a measure of a bank's ability to meet an outflow of deposits. This ratio increased significantly during the pandemic as bank deposits and liquid assets swelled, but has since declined for 6 straight quarters. The first quarter liquid assets to deposits ratio declined slightly to 36.1%, which marked a return to the pre-pandemic average, while cash and balances due from depository institutions increased 10.2%, and total deposits declined 2.5% from the previous quarter. These factors were offset by a decline in securities of 4.6% and an increase in pledged securities of 22.4%. This next chart shows that total loan balances declined modestly from the previous quarter. Loans transferred to the FDIC as receiver as a result of bank failures in the first quarter, combined with a seasonal decline in credit card balances, were the major contributors to the decrease in the balance of total loans. Excluding the transfer of loans to the FDIC as receiver, quarterly loan growth would have been 0.4%, a substantial reduction in growth from the previous 6 quarters, but still positive. The growth was led by modest increases in 1-to-4 family mortgages and loans to non-depository institutions, while other major loan portfolios remained relatively flat, with the exception of the previously mentioned decline in credit card loans. The banking industry reported annual loan growth of 7.5% from the previous year, well above the pre-pandemic average. The growth was led by higher 1-to-4 family residential mortgages, consumer loans, and commercial and industrial loans. Compared to the industry, community banks reported stronger loan growth, increasing 1.8% quarter over quarter and 15% year over year. Non-farm, non-residential commercial real estate loan portfolios and 1-to-4 family residential mortgages drove annual loan growth for community banks. Loan growth has been robust during the past year, driven by pent-up demand from both consumers and businesses, as well as higher inflation. Recent surveys, however, indicate that demand is waning and underwriting standards are tightening, which may hinder loan growth rates in coming quarters. Now, this next chart shows that asset quality ratios for the industry remain favorable. The non-current and net charge-off rates increased modestly in the first quarter, but remained below pre-pandemic averages. The non-current rate increased 2 basis points from the fourth quarter to 0.75%, driven by increases in non-farm, non-residential real estate loan balances. Seasonal increases in credit card net charge-offs drove a 5 basis point increase in the industry's net charge-off rate from 1 quarter ago. The early delinquency rate, that's loans past due 30 to 89 days, declined slightly from the prior quarter, driven by a seasonal improvement in past due auto loans and lower delinquencies on 1-to-4 family residential loans. Community banks reported stable credit quality metrics that, like those of the industry, remain better than pre-pandemic averages. The community bank non-current rate increased 1 basis point from the previous quarter to 0.45%, and the net charge-off rate declined 2 basis points from a quarter ago to 0.09%. The early delinquency rate for community banks increased slightly from the prior quarter. Now, this next chart shows that the allowance for credit losses grew at a faster pace than non-current loan balances, resulting in an increase in the reserve coverage ratio. The ratio of the allowance for credit losses to non-current loans increased from 184.3% 1 year ago to 219.5%. That's the highest level on QBP record. Our next chart shows that the number and total assets of banks on the problem bank list. Banks on this list have a CAMELS composite rating of 4 or 5 due to financial, operational, or managerial weaknesses, or a combination of those issues. And the number of banks on the list increased by 4 from the previous quarter, reflecting movement from banks coming on and off the list to 43 institutions, and total assets held by problem banks were $58 billion, up $10.5 billion. As you know, 2 banks failed in the first quarter. This next chart shows that deposits declined for a 4th consecutive quarter. Total deposits were $18.7 trillion. That's down 2.5% from the level reported in the fourth quarter. That's the largest reduction reported in the quarterly banking profile since data collection began in 1984. A reduction in uninsured deposits was the driver of the quarterly decline, since insured deposits increased. Uninsured deposits declined by 8.2%. By contrast, insured deposits increased by 2.5% during the first quarter. This next chart shows that the deposit insurance fund balance was $116.1 billion on March 31. That's down about $12.1 billion from the fourth quarter. The vast majority of the decline in the deposit insurance fund was driven by the failure of 2 banks and amounts set aside for the anticipated failure of First Republic Bank, which subsequently failed after the end of the first quarter. The decline in the deposit insurance fund balance does not include the cost of protecting uninsured deposits pursuant to the systemic risk determination made for the 2 bank failures that occurred in March. The FDIC is required by statute to recover those losses through a special assessment, offsetting the losses associated with protecting uninsured depositors and eliminating any effect on the deposit insurance fund balance and reserve ratio. The decline in the DIF balance was partially offset by assessment income, which increased by about $1 billion from the previous quarter, largely because of the 2 basis point increase to the deposit insurance assessment rate schedules that became effective on January 1, 2023. Insured deposits increased by 2.5% during the first quarter, bringing year-over-year insured deposit growth to 3.1%. Together, the decrease in the deposit insurance fund balance and the increase in insured deposits caused the reserve ratio of the fund to fall to 1.11% as of March 31st. The FDIC adopted a DIF restoration plan on September 15, 2020, that would return the reserve ratio to the 1.35% statutory minimum by September 2028, as required by law. In spite of recent stress to the banking industry, the reserve ratio currently remains on track to reach the 1.35% minimum by the statutory deadline. The FDIC will continue to monitor factors affecting the reserve ratio, including but not limited to insured deposit growth and potential losses due to bank failures and related reserves as required under the current restoration plan. So, in conclusion, the banking industry has proven to be resilient. In the first quarter, net income was flat but still high by historical measures. Asset quality metrics remained favorable, and the industry remains well capitalized. However, the industry's quarterly results do not yet fully reflect the stress that began in early March. The banking industry also faces significant downside risks from the effects of inflation, rising market interest rates, slower economic growth, and geopolitical uncertainty. These risks have the potential to weaken credit quality and profitability and could result in further tightening of underwriting, slower loan growth, and higher provision expenses. Given these risks, the FDIC will be focused on monitoring the condition of the banking industry, including the impacts of the recent bank failures on liquidity, and taking appropriate supervisory actions. That concludes my statement, and I'd be glad to try to respond to your questions. Thank you all.
Thank you, Mr. Chairman. We'll now turn to your questions. Please use the raise your hand feature and I'll call on you. And our first question is from Victoria Guida at Politico. Go ahead, Victoria.
Great. Chair Gruenberg, I was just wondering, you mentioned in your remarks about commercial real estate and how that's potentially a big risk that's looming out there. I'm just wondering how you all are thinking about that from an examination perspective, supervision perspective, and how you're advising banks that have significant CRE portfolios on how to manage those risks.
Well, thank you, Victoria, and that's really an important question. Fair to say, commercial real estate exposures have been a focus of our supervision work for some time now and will continue to be a priority. You know, there are significant numbers of banks in the United States that have significant CRE exposures. We're particularly focused, as you know, on office buildings, on commercial office space in a number of large metropolitan areas where we have the leases on buildings expiring, and the holders of those properties may not be able to charge as much on the renewal of those leases, while the cost of financing the mortgages on those properties may be going up. So it's a significant risk exposure for our institutions. We're asking our banks to prioritize how they are managing those exposures and prepare for the downside risks as the economy evolves over the next 6, 12, and 18 months. And it's going to be a matter of ongoing attention in our supervision work. And thanks for asking that question.
Our next question is from Stephen Gandel at Financial Times. Go ahead. Steve?
Yes. Hi. Chair, what are you doing, or the FDIC doing to monitor the things banks are doing to deplete their, assist in helping with depleted deposits? I'm talking about brokered deposits or borrowing or reciprocal deposits. How's the FDIC approaching, again, the moves that banks are doing to shore up their financials?
Yeah, look, first of all, as I mentioned, insured deposits have stayed steady and in fact have been increasing, and so the decreases in deposits have been on the uninsured side, and we clearly have had some outflow over the past year or so, deposits seeking higher returns, and some conversion of uninsured deposits to insured deposits. But as I indicated, the outflow has moderated for institutions. So the general picture is it remains relatively stable, but I think institutions are going to be paying close attention to their deposits and levels of liquidity, and that's obviously going to be an ongoing focus of the FDIC from a supervisory standpoint.
And can you say anything about the status of the fund, which is, the ratio is lowest it's been since 2015? Um, you said, what's the path back to? You said and it's below your statutory level.
Been, as you know, since 2020, and that's when we implemented our initial restoration plan. And in 2022, we actually bumped up assessments before recent events. And the fund is below the statutory minimum. But we do have in place the assessment increase that we previously imposed. And we have until September of 2028 to get back up to the statutory minimum for the reserve ratio of the fund of 1.35%. And as I indicated in my comments, based on the current assessments, we actually think currently that we're on track to meet that statutory requirement by the September 2028 deadline.
Thank you.
Our next question is from Andrew Ackerman at the Wall Street Journal. Go ahead.
Hey, thanks for doing the call. Can you shed any more light on what fueled the decline in unrealized losses?
Yeah, there's been as you probably know, a decline in medium to long-term interest rates, and that has actually resulted in the reduction of the unrealized losses on the balance sheets of our institutions. It's when you have longer-term assets and interest rates rise above them, then the value of those assets declines. When the interest rates themselves come back down, the value of those assets increases. And Andrew, that's the reason that the aggregate unrealized losses on the balance sheet of the banks decreased by about $100 billion from the previous quarter.
Thanks.
We'll go back to Victoria at Politico. Go ahead, Victoria.
Thanks so much. I also wanted to ask, Chair Gruenberg, you mentioned in recent testimony that it was feasible for the agencies to put out a rule on executive compensation. Obviously, I know that's been in train for a very long time. There's been a couple of proposals already. So I was just wondering, can you talk about what the agencies are doing on that? Is there active work going on to get a proposal on executive compensation? And is that going to be sort of based off the 2016 proposal?
Yeah, Victoria, actually, I think the answer to both of your questions is yes, and thanks for asking it. I think, as you know, there are 6 agencies involved in that joint rulemaking. I do believe there's alignment across the 6 agencies in a desire to come back and act on that rulemaking. And I think staff of the 6 agencies are meeting on a regular basis, and I think there's going to be an effort to repropose a rule. I think it will be based on the proposed rule that was pending back in 2016.
It would be slightly different.
Well, let's see, but it would certainly be based on that 2016 rule.
All right, thanks.
Evan? Go ahead. Evan,
Hi, hi. Thanks so much for the time today. And just following up a bit on Victoria, do you think that a reproposal could come this year? I mean, do you have a sense of timing and how far along folks are on that?
Always beware of predictions, I might say, but I think there's a commitment across the agencies, and I would hope we could come forward with the reproposal this year.
And I guess I'll ask another tricky timing question that involves other agencies as well. Do you have a sense of timing on the Community Reinvestment Act and where that is?
Yes, as you know, that's a top priority for the banking agencies. It's ambitious rulemaking. I am hopeful we can get to a final rulemaking in the very near future. To be candid with you, I don't want to put a prediction on it, but it's a focus of intense attention and high priority, and I think we're aiming to get to a final rule in the near future.
All right, thanks so much.
Thanks, Evan. Any additional questions? Oh, Stephen Gandel with Financial Times. Go ahead, Steve.
I think I mean, I know the signature report talked about referring some of the findings that you had to other agencies from signature. Is there an ongoing in the terms of the two failures in the first quarter and the more recent First Republic? Are there ongoing actions the FDIC is taking, either against the old institutions or the executives of the institutions?
And the answer to that is yes. As you may know, in every bank failure, the FDIC actually has a statutory obligation to investigate any misconduct by the board and management of the failed institutions. And those investigations started immediately following the failures and are, a major focus of attention for us. And as you know, if the investigation determines that improper conduct occurred, we have a number of authorities to bring to bear, including restitution, as well as banning individuals from the business of banking.
We have time for I guess we have maybe two more questions. Allison, we'll go to you first. Allison Bennett at S&P Global.
Hi, can you hear me?
Yes, go ahead.
Okay, great. Yeah, I was just wondering, you had recently put out a proposal on the special assessments that some banks would have to pay in order to refill the deposit fund. And I just wondered if you had received any comments. We understand that some banks saw their uninsured deposits drop during the first quarter of 2023, and I wondered if that would be something that you would take into consideration as you work to finalize that proposal.
Thanks for the question. You know, as a matter of law, the FDIC is required to impose a special assessment on the industry to recover any losses to the DIF from protecting the uninsured deposits. And we're required by law to do it through a notice and comment rulemaking. So we issued a notice of proposal and provided a 60-day comment period. We're receiving comments now. I imagine we're going to get comments on the issue you raised and perhaps quite a few others, and we'll obviously give close attention to the comments we receive before finalizing the proposal.
Thank you.
Our last question goes to Abrima Sane at American Banker. Go ahead, Abrima.
Hi, thanks for taking my question. Chairman Gruenberg, could you provide some insight into the prevalence of digital assets within the banking system and how that's evolved in the first quarter? I saw that uninsured deposits dropped, so does that shed any light? Does that suggest anything?
I don't I don't know that there's really a connection there. And in terms of digital assets in the banking system as a whole, if you're referring to crypto assets, the exposure of the banking system itself has been quite limited in that regard thus far.
Thank you.
Thanks, everyone. That concludes our live stream. And if you have additional questions, senior staff will be on the line to take those, but we'll end the live stream here. And if you'd like to ask us some additional questions, just stay on WebEx, please.
Listen, thank you all. Thanks a lot.